Hey hamsters, just imagine Friday night, cozy vibes, candles, and trading? I mean, when we talk about trading, we always hear about candles. So what are they, how to understand them, and how important are they? All in today's episode of Hamster Academy. One of the steps of successful trading is developing a strategy and therefore reading a chart. Yes, we know if you put your life savings in Bitcoin back in 2009 and did nothing else, you'd never have to work again. But we can't go back in time, so that means we can only strategize going forward. Unfortunately, untrained eye charts are scary. Yes, we'll admit it. However, a few pictures and a little explanation and you'll be on your way to understanding the basics. Let's nibble into 7 key charts. First, why should you even care? Reading charts is essential for traders to find the best opportunities in the market. We look at technical analysis since it helps investors find market trends and predict the future price movements of an asset through the study of charts and indicators. Number 1. Arguably the most useful and complicated measure is the candlestick. The candlestick is a vertical bar that represents a set of data relating to the price of a given asset at a time. These are often colored, either red or green, representing whether the price is going up or down. Therefore, you see a red candlestick, and it means the price of the asset closed lower than it opened. This is why some traders will call these falling candlesticks or bearish candlesticks. Then you have the green candlestick, which indicates the price of the asset closed higher than it opened. On their own, they might not look like much.
Boring!
But looking at several of these candles combined, and you can see a picture of the market. This would then allow an investor to determine if it is time to buy, since the price is likely to rise, or if they should hold off, short, etc., since the price is likely to fall. Oh, let's break it down further. Bullish and bearish patterns. Bullish patterns indicate potential upward movements and include formations like the hammer. In the hammer, a long lower wick suggests buyers are pushing prices up again. Something like this would show a reversal or bullish trend. On the other hand, there are bearish patterns which signal potential downward movements. In this situation, formations like the shooting star indicate sellers are taking control. Candlestick patterns might be the easiest to get the grasp of, so it's a good starting point. However, it's not the only chart worth considering. A good investor should also look at support and resistance levels, which you can find using trend lines.
Support and resistance or key levels are one of the most important things that you must master when trading.
Number 2. Support levels are the lowest price the asset will reach before it rises. This is an indication that there will be too many buyers. As an example, if a stock is undervalued, investors are likely to buy at that price until the market fully absorb all of their demand. You can find the support or resistance level with a trend line. An uptrend line looks at the asset's lowest and second lowest lows in a time period. The levels that touch this trend line are your support. On the other side, a downtrend line is drawn using the asset's highest and second highest highs. As is true with our first example, the levels touching the line are resistance levels. So, what do you do with this info?
I don't know.
Or a better question, what could you do with this info? You could choose to buy near the support of uptrend lines and sell near the resistance of downtrend lines. However, you may also come across a case where the price of an asset will move between a certain range. If this occurs, analysts may look for a breakdown or breakout, which would indicate the asset moving outside of the given range. Did you know support and resistance levels can also be used with long-term moving averages? This takes us into our next topic. Number 3. Moving averages. moving averages are one of the most common technical indicators. Investors love these indicators since it helps smooth out price data and show trends.
Having a clear view of the trend can help an investor decide whether to buy, sell, or hold a position.
Some of the most common moving averages are 10, 20, 50, 100, and 200-day periods. How do you read this? When shorter moving averages like a 50-day cross longer moving averages like 200, a light bulb goes off for a potential buying opportunity. Keep in mind that 50-day and 200-day moving averages are closely watched in the charts, so much so that investors know that when the 50-day SMA crosses below the 200-day SMA, a death cross forms indicating a price drop is coming. In another scenario, when the 50-day SMA crosses above the 200-day moving average, a golden cross is formed and investors ready themselves for a price rise. Of course, then there are a few other technical indicators that might come in handy. Here is 3 more in our bonus round.
Bonus.
Number 4. On-balance volume. Once upon a time, there was a man named Joseph Granville. Joseph, sometimes called Joe, believed that trading volume was a major driver of price movements in markets. And with that, the on-balance volume indicator was born. Investors used this indicator to identify a breakout, perhaps before the price line. Ready to calculate? On-balance volume has a few ways to calculate. You got that?
No.
If not, there are also tools, but just so you have an idea. This takes us to... Number 5. Moving average convergence divergence. Yes, this one is a mouthful. The MACD is an indicator that measures the difference between the 12 and 26-day exponential moving averages to form the MACD line, which can help to identify both buy and sell signals. MACD also has a signal line, aka a 9-day EMA. And when the MACD crosses above the signal, investors often recognize it's time to buy. And then, of course, if the MACD crosses below, investors tend to sell. Now, here's one for the strong. Number 6. Relative Strength Index. The RSI is a momentum indicator that investors use to measure whether an asset is being overbought or oversold. It is also an oscillator, meaning the line goes literally from 0 to 100. And, of course, everything in between. What do you look for?
I don't know.
If it's above 70% or below 30%. Over 70, overbought means investors tend to sell. Under 30, underbought. Then they usually buy. Now it gets a little more complicated. Meet lucky number 7. Bollinger Bands. Bollinger Bands are for short-term price movements. Calculations come from a 20-day moving average and the addition or subtraction of a standard deviation from the moving average. Unlike the others, the bands really only show high or low volatility and need to be accompanied by another indicator. And there you have it. Hope this was helpful. Thanks for watching. Subscribe and remember, hamsters have power. One for all and all for one. Bye!